Today's extended trading idea looks at NVIDIA, one of the most influential stocks in global equity markets right now and a central pillar of the artificial intelligence megatrend. Over the past year, NVIDIA has played a major role in pushing global equity indices higher, as enthusiasm around AI infrastructure and data center investment has intensified. But as we approach late February, with earnings seasons now largely behind us and equity indices currently trading at elevated levels, the key question becomes, is NVIDIA still seasonally positioned to lead the market from here? Or does history suggest this is a phase where leadership typically consolidates? To answer that, let's have a look at the seasonal data. Now, season analysis of NVIDIA, you can see here this chart shows NVIDIA's seasonal performance over the full year based on long-term historical data. And what stands out immediately is that NVIDIA's strength is front-loaded. Performance tends to build through the first half of the year. If we look from early January through to the end of June, we can see that the average return has nearly been 40% over the last 10 years, and the maximum gain has been an incredible 196% in 2023. Once we're through that first half of the year, we tend to see a pause or a consolidation later in the year. And you can see here as we get into the summer, July through to sort of mid-October, there is an average return of 5.56%, just indicating a consolidation around the middle of the year. And then there's a mixed performance from the end of the year, from October 30th into the end of the year. You can see some years that's been pretty pronounced gains, other years we've seen some significant losses. So from a seasonal perspective, this does tell us something important. NVIDIA has historically rewarded early year positioning rather than late cycle chasing. Look, you can see there the average return first half of the year, nearly 40%. From the middle of the year and to the end of the year, you see the average return is 9.62%. And you can see that by late February, the stock is typically within a constructive seasonal window. And you can see here from if you take 26th of Feb into the end of June, you've still got an average return around 25%. So seasonally speaking, this is a good time of the year historically for NVIDIA gains. Now let's put NVIDIA into context by comparing it with the S&P 500, the broader US equity benchmark. Now, NVIDIA's seasonal profile, you can see straight away, look, it shows a steeper, more concentrated gains. If you look at the index on the left-hand side, you can just see that the gains are that much more pronounced in NVIDIA stock. The S&P 500, by contrast, tends to grind higher more gradually with less dramatic bursts of performance. And that's the first sort of obvious difference that you can know. And obviously that's explaining why NVIDIA has been such a major leader of major indices. Now, this difference in shape also matters. It tells us that when NVIDIA outperforms, it often does so decisively. But again, those leadership phases, they're not evenly spread across the calendar. By late February, NVIDIA has historically done quite a lot of the heavy lifting relative to the broader market. Now, if we look at the tech sector of the S&P 500, and for this, I'm using the XLK ETF, which is the Technology Select Sector SPDR fund, and that represents the S&P 500 technological sector. Now, like NVIDIA, you can see the technology sector tends to perform well in the first half of the year. If we look from Jan through to the end of end of June, early July. See, the average return is 12.21%. So again, the sector does tend to have decent gains in the first part of the year, just like NVIDIA, but the sector's gains, they're typically smoother, okay? They're less aggressive than NVIDIA's. So you go back to NVIDIA and you see NVIDIA's gains at the first half of the year, right? Much more aggressive gains. And if you compare it with the S&P 500, the index as a whole, you can see that these gains are much more moderate, of an average return of 5.87%. So NVIDIA leads with the most aggressive amount of gains, S&P 500 more moderate gains, and the Technology Select XLK sector fits somewhere in between. So what this tells us is that NVIDIA has historically led the technology sector early in the year rather than just simply following it. And so NVIDIA has tended to act as a leadership stock. It is not just a passive beneficiary of sector flows. And this seasonal structure aligns well with the macro backdrop we usually see early in the year. Markets tend to reward, clarity after earnings season, clear visibility around capital expenditure plans, and then the confidence in long-term growth narratives. Now, it remains to be seen whether NVIDIA is going to satisfy the market's increasingly rising demand for excellent performance in those areas. And NVIDIA has benefited from this in the past quite significantly. And given NVIDIA's exposure to AI infrastructure, data centers, and hyperscaler spending, right? That's really what's been driving a lot of these gains. However, right, by late February, the markets are starting to shift focus from the results to sustainability. And the sort of questions that the market's going to be asking is, how durable is AI spending? How concentrated is earnings growth? How sensitive are high valuation leaders to shifts in liquidity or rate expectations? Answer, highly sensitive. And that's why this point in the calendar matters. So when we combine NVIDIA's historically strong early year seasonality, its tendency to lead both the S&P 500 and the technology sector, and a macro environment where confidence is high but expectations are demanding, we're left with this timely question. Does NVIDIA continue to justify its leadership role from here? Or does history suggest that this is the stage where performance becomes more selective and relative rather than index driving? Now, while nobody can predict the future, using an extensive database like this that Seasonality gives you, especially relative to performance, helps investors better understand where leadership has historically strengthened and where it has tended to pause. So if we took from February the 25th, so we took it into the 1st of August, what we can see is there's still a very healthy average return of 35.62%. And to help us to see the historical drops, the other thing to be aware of is that standard deviation is very, very high. So that means that the range of results for NVIDIA during this period are very broad. And not only are the results broad, but look at the volatility. So 2020, yes, in this period, NVIDIA made a profit of 68%. Wow. But look at the maximum drawdown, 25%. Similarly, look at 2025. Yes, the market made a gain of 37.21%, but look at the maximum drop, 25%. So we had a maximum rise of 41% during the pattern, a maximum fall of 25% with a final result of 37.21%. And the volatility is really quite pronounced across the whole range of data. So what that tells you is, technically, looking at a NVIDIA chart, you can see that the drawdown has on 1, 2, 3, 4, 5, 6 occasions, the drawdown has been greater than 10%. And then on 1, 2, 3, 4 occasions, the drawdown has been greater than 15%. And then 1, 2, 3 occasions, it's been greater than 20%. So that means wherever NVIDIA's share price is at the end of NVIDIA, it wouldn't be unreasonable to potentially look for a dip to potentially buy on a 10, 15, 20, or even 25% dip. And this seasonality can help us, even if the market does decide to go out of favor with NVIDIA. Perhaps the market decides that AI spending is less durable, that the earnings growth is not as concentrated as it was like, that the high valuation is not justified, and let's say we see a deep dip. Still remember that even in years where there's been a deep dip, there's ultimately been some pretty significant gains. So NVIDIA is still very interesting at this time of the year. And I hope that this has been a helpful lesson to see how NVIDIA's seasonal behavior compares with the S&P 500 and the technology sector, helping traders and investors put market leadership into historical context is one of the key benefits of using SeasonX.